go. All right. So today was actually a surprise day. Today was a trend day to the upside. But since the Saturday blueprint, I've talked about nonstop to make sure your eyes are on the watch list. The watch list is going to tell you the narrative, and the watch list is going to tell you the story. So we have two insanely powerful mega cap tickers today that printed plus 4%, which is an absolutely insane move for both of those tickers. Number one, Nvidia. Number two, Apple. So we have Apple and Nvidia with breakout expansion. And we know that any ticker that's on the Mag 7, especially the indices, if they're going red to green, so if they're gapping down and then flip green, that tells you a very important narrative as well. That's what happened with ES and NQ today. NQ opened red, ES opened red, and then we flipped green. So that tells you essentially all that you need to know for today's session, but I think the trend day is still a surprise. The trend day was definitely created off the NVIDIA news. The NVIDIA AI news, I believe, is what dropped. And that's why we don't predict where the market's going, because we have absolutely no clue. It could have been negative news, it could have been bad news, and we could have been flushing everybody out, but it was positive news, and we ended up flushing everybody out to the upside. I saw a lot of people shorting today. I don't think there's any bad ideas with shorting today in the macro resistance all-time high, but it is what it is. If the market wants to be extremely healthy and it wants to trend because of news, there's absolutely nothing that you can do, right? We cannot fight the news events like that. So let's go ahead and discuss. Cannot hear. Make sure Discord audio is connected via settings. Yeah, so make sure you're connected via your settings. You should be good to go. Very quickly, let's just go ahead and draw some new structures here. So we have 67, 56, 75. That is today's high of day. That is the new all-time high resistance. And now these will change. So this is not the previous all-time high structure anymore. This is the Thursday overnight high. Last Thursday overnight high. And now this is the previous all-time high. And that's pretty much it. I don't see anything else really that we need to add beside the new all-time high level. So before we jump into the notes for today, the ES guide, before we jump into essentially the write-up for tomorrow, the ideas heading into tomorrow, let me know what you guys did today. Let me know if you shorted as well, because I think shorting, it wasn't a bad idea, but it is what it is when it comes to the economic markets, right? If there's going to be positive news, we can just go up in a straight line. If there's going to be negative news, we can go down in a straight line, especially on these lower time frames, because the lower time frame has been chopping overnights, and we did get weakness overnight too. So this weakness is only really represented on the smaller time frame, right? So we have overnight weakness. We had Sunday holding below 67.1975. So this box right here definitely showcases that some sellers are active, right? This box right here, but it only showcases sellers are active on the smaller time frame intraday charts. If you go to the higher time frame, you don't see that at all, really. You don't see the Sunday price action literally at all. So that's non-existent. That weakness does not exist on any time frame besides the smaller time frame. And I think a lot of people may have tunnel vision on that, but nonetheless, I think the setup was there. If you took short at 67.19 or 67.31 and you took the loser, that's all good. But if you're shorting 67.19 and you're shorting 67.31, if you take a minus 1R, are you going to continue shorting because of revenge trading? I think we've all been in that situation before where we're shorting and we're saying to ourselves, this is not making any sense. Why are we trending in a straight line? It doesn't make any sense on a specific day like today. We should probably just be seeing range-bound trading. But Nvidia is pumping, Apple is pumping, Tesla was pumping, and Q went red to green. So if we're going to continue shorting up here and up here, then that to me doesn't really make much sense. But if you take the minus 1R, the macro resistance, that's all good, right? It's all good. For longs today, I don't see a setup for long. It's simply just a trend day. You would just have to long broken resistance. So the only way you could do that is if you're longing 67.19 and 67.31, right? Other than that, I don't see an intraday false breakdown to trade. Let's look at the first hour range. Yeah, so literally just a straight line upwards. I'll be completely honest, guys. I was not even looking at the chart today. I knew that I don't want to mess around with all-time high. I know that I don't short these market parameters. So I pretty much did not look at the chart today. This is my first time looking at the chart since the first hour range was printed. But yeah, no false breakdown today. There was a false breakdown at 3 a.m. And as we know, 3 a.m. sometimes does produce opportunities for the London session. I shorted MNQ, but definitely need to learn when to do it. Had to lose a couple before. Revenge trading, but eventually won some. Not a great trade in my opinion. More luck than anything else. All-time high is a challenge to short for me. Yes, all-time high is extremely challenging to short. If not, it's just a level you completely want to ignore. I think we've talked about that before, where all-time high is the trappiest level on the chart. And it's the trickiest level to trade on the chart. Whether you're longing or shorting all-time high, it's extremely tricky because you have essentially the internal context is split, right? You don't know if resistance at all-time high is going to be extremely strong. You don't know if bulls are going to print bullish time frame alignment. Those two scenarios, however, bullish time frame alignment and all-time high retaining resistance, is the most finicky situations on the chart, because think of it like this. If we are going to get a breakout above all-time high, then the market needs to be very strong and we need to see incentive buyers. If we're going to see all-time high be resistance, then we need an already very strong market to showcase signs of weakness. And we know that's difficult to do. If a market is extremely optimistic, if it's extremely healthy, then we're not going to get much pullback. And that's what's happening this month. Where do we see the entry alert for today? So for today, I don't have a trade. If I have a trade, I'll alert people and I'll let you guys know what's happening. September 2nd was the last time I traded the futures market, September 2nd. If I go back to this chart, I bought this wick right here on September 2nd. I unfortunately got poked out on the way up, but in my opinion, that was the best trade of the month so far. Probably the best trade in a few months. And I got a little less than 6R on this trade. So the next time we get a macro pullback, I'll be interested to trade. But if we're not going to get a macro pullback, then I'm not interested to trade. I will simply be on the sideline. And we haven't received a macro pullback since September 2nd. Other than that, it's just been very clean higher lows from the intraday perspective, right? This wick from FOMC last week, it did not break down into macro support. And then this wick, or this candle on September 5th, exact same idea, did not break down into macro support, simply sustained the intraday trend, and we've gone up. Let's see. We've gone up about 325 points, 5% since September 2nd. Eventually, this trend will conclude, which is why we have the line in the sand. The line in the sand is 66.70. When the intraday trend concludes, then we will look for a trade. Can you link me to the September 2nd post? Yeah, no problem. Let me go ahead and share this document for you. I created this document analysis. Click the link right there. This is how I journal my trades because I'm a macro time frame trader. I don't have many trades pretty much. It depends on the environment, right? But I would say 3 to 5 trades a month, I'll be happy. If I get more than 5 trades in a month, I'll be even happier. But whenever I journal, it's extremely, extremely detailed. Right? So this is how I journal. You did not hold any positions since September 2nd. I've been holding stocks. But for futures, I only held from September 2nd to September 5th. But other than that, I've been holding UNH, Tesla, stocks in general. Yeah, so the alert from the Discord is in the document. Let's see. It is right here. So 2025-09-02, 9:35 a.m. picked up the fill. It was 63.8750 at the time because this was the September contract. And then we got the easy move into first targets. So this is how the Discord looked at the time. And then let me bring up the Discord on the live stream so you can see the channel. Maybe I can scroll up and show it as well. So this channel right here alerts, dairy day trades. This is where the macro high quality lows of interest are executed. And every day I share the trade plan and I share the levels as well. So the closest level that we have right now is 66.11. This is about 2% now because we made all-time highs. So this is about 2% from all-time high. Let's see if I can scroll up here to September 2nd, 10th, 3rd. Yeah, so here it is right here. So at 8:55 a.m., we sent out the trade plan. We had 63.8750 right here, minus 2% from all-time high, 50% retracement using the August 1st low to all-time high. So my eyes are lighting up. 64.3075 had a great entry overnight for at least one target, but its failure is resulting in deeper pullback and liquidation. Anybody that bought in last week's range and back held against the false breakout structure is trapped, period. And then this creates a liquidation event. And then the onus is on the macro time frame buyers to start in or to start buying some dips. If no dips are bought, then selling will simply continue. Important to apply the false breakdown fib trap methodology so we can visually see from price action that sellers are exhausted and larger time frame buyers are stepping in. Below 64.30, we have 63.8750, which is a great spot to watch for a high quality area of interest buy zone. So everything is implemented in the trade plan, and then execution wise is right here. In that document, I talked about the 3 entry models that we have: the predetermined, the false breakdown, and the Fibonacci trap. All 3 of them were presented on September 2nd. So here is the predetermined entry model. You literally just buy the level, swing stop loss. You don't get stopped out here. So your stop loss is 63.67, entry is 63.87. You don't get stopped out, and you can ride the trend via a swing. And then if you want to take the false breakdown, this is how it looks. You enter on a market order when you see that sellers are visually exhausted by price action and visually trapped, especially at these macro support levels. And then you trade it like so. And then the Fibonacci trap is literally just waiting for the higher low opposing leg. So you get the false breakdown right here. You get a move up into 63.99 resistance. And then you get a move back into 63.87. You create your higher low. And that's the Fibonacci trap. Alrighty, let's quickly jump into the notes for today. As we know, today is really nothing too crazy as it pertains to execution. So the last contract, the September expiry contract, that's the contract that we were trading on September 2nd, and then we rolled over last week. Right. So in Saturday's blueprint, we discussed the previous all-time high needing to become a ceiling, and so far it has, stemming from Sunday's open into 1 a.m., in which sellers are now contesting last Tuesday's overnight high, working on developing a false breakout pattern. This level marks last Thursday's breakouts. After weeks of nothing but upside, let's see if the market can now work on macro pullback. For today specifically, let's see if we need to digest a bit as well in the prior 2-day range so the structures are extremely clear. So we didn't get the macro pullback. We didn't get digestion in the prior 2-week range. We simply got continued all-time high breakout expansion because we had news in the real world today. We had Nvidia news and we had Apple news. Those guys are plus 8% combined, which is absolutely nuts. And that's obviously going to drag the S&P and that's going to drag the NASDAQ higher. So that's literally what happened today. Because the overall regime of the market is extremely bullish, I think it makes sense that we got a trend day to the upside. And then in the notes, we knew that buyers wanted to sustain above 66.9650. So buyers simply want to sustain 66.9650 and continue printing new highs. That's the most bullish scenario possible. That's what they want to do today. That's how bulls sustain absolute control. 66.9650 is right here. This is the 3:15 a.m. low. And then the 9:30 a.m. low is right there. We opened above it, we held it, and we just took off. We broke out macro resistance, and we know that breaking out all-time high equals bullish time frame alignment. Bullish time frame alignment was in play today above 67.3150. You can even see price action confirming it here because we got a little bit of consolidation at 67.3150, and this consolidation resulted in confirmation of bullish time frame alignments as sellers were unable to sustain the all-time high macro resistance. From a setup perspective today, I don't see any intraday setups other than the short at all-time high. I saw a lot of traders take that today. Absolutely fine, but you can't revenge trade. You cannot revenge trade. We've all done it before. If you lost at the all-time high by shorting it and you take the -1R, take it gracefully, take it humbly. Don't start shorting bullish time frame alignment because you're frustrated and you're upset. You're going to just lose more money, and we've all done that before. If you've done it today, simply journal it, learn from it, and move on. Refresh for tomorrow. Tomorrow is going to be an absolutely brand new day. For longs, I don't see any intraday false breakdowns. Really, just a tricky day. Just a tricky day because of what happened in the real world. But all in all, it shouldn't be a day where you're blowing up your account, and it shouldn't be a day where you're too frustrated, right? Just take it with a grain of salt, essentially. Because news, we know how news likes to operate. For me personally, I'm still sitting on my hands. I don't know how I have the mental capability to do this, but somehow I do. I've been sitting on my hands since I got trailed out on September 5th. I made a little bit less than 6R on this setup from September 2nd into September 5th. And since then, I have not received a macro pullback. The FOMC event last week was so close. Let's see. It got about 30 points away from the 63 or 65, 77, 50 macro low of interest. But because the FOMC low did not cross my macro low of interest, what am I doing? Am I breaking my trade plan? Am I breaking my rules? Am I just buying now because of what I think, what I see? Or am I buying because of what I know and what I need to see based on my trade plan? There's a very distinct difference between what I just said. And the distinct difference is literally the difference in retail traders and professional traders and institutions, right? So follow your trade plan. If you had short in your trade plan today at the macro resistance and you took a loser, absolutely nothing wrong with that. But if you took a short today at the macro resistance and it wasn't in your trade plan, you just wanted to catch the top, right? Maybe you saw on social media somebody said the top is in and you shorted it, but it wasn't in your trade plan and you didn't have your risk managed even beforehand, then I think there's a problem there as well. Other than that, let's delete these notes. Tomorrow is a new day. We will see. My lean, obviously my lean does not matter, but my lean is still that this FOMC low is a target. Eventually, we will get there next week, next month, or not we will get there, but that is my lean next month, next week, next year, whatever. We can get there. And if we are to contest a macro low of interest, I will be ready. I will be ready when that low gets contested. Let's see, at the 4-hour time frame, the line in the sand might become a macro low of interest. It just depends how much we want to expand into tomorrow and the rest of the week. We do have a little bit of news tomorrow. We'll see how that impacts the chart. The line in the sand is minus 1.3%. So if we do get to the line in the sand, I will be talking about this in my commentary. And it depends how price action looks tomorrow when the overnight price is developed, if this becomes a high quality low of interest. So stay tuned for the pre-market ES guide if 6670 is going to now become a macro low of interest instead of just the line in the sand for sellers to break down. So stay tuned for that. Let's quickly talk about premium selling now. Let me know in the chat who sold premiums on Sunday or today. Remember, the futures market opens on Sunday at 6 p.m. So you can start selling premium as early as Sunday, 6 p.m., right? If you're somebody that's selling very far out the money, you can start selling at 6 p.m. on Sunday, and you can be your routine can be very consistent, right? Because we get access to the market on Sunday with futures, but if you're going to sell some premium with stocks, you have to wait for Monday, the RTH open. And if you're selling premium for any of the stocks that we talked about, so let's go into, let's say, for example, let's say NVIDIA. If you're selling puts on NVIDIA, like we talked about in the stocks channel, let's say you had the 170 strike, minus 5% from where we closed last week, you're probably going to collect all that juicy premium, right? All-time high looks like it's going to be the next line in the sand for NVIDIA. If it pumps above 184, you're probably going to get all that premium. And that's what we play for. Even if you didn't collect those premium, let's say you got it signed at minus 5% at 170. The reason why we are wanting to get assigned there is because that's where we're going to look for a high quality low of interest anyways. That's where we're probably going to buy Nvidia anyways. That's probably where we're going to be talking about Nvidia anyways. So collect some premium. I know there's a lot of professional traders out there with a lot of money, and they get 30 through 40% of their annual return just by selling premium, right? It's pretty nuts. And especially in a bullish environment, we've been in a bullish environment since April, at the end of April. That's it's pretty reliable return. Pretty reliable. And if you are to get assigned, then you're happy because you want to buy there anyways. And that's why the synergy makes sense. Other than that, that's pretty much it for today. If you guys have any questions, comments, concerns, you can let me know. Let me quickly scroll up here and see what page we are on with the book. 193. Almost done. My dilemma is that I don't have any shares with these companies, so I can't really take advantage of the premium selling. Should I wait for these guys to dip? That's a great, great question. And yes, I think you should definitely wait for somebody to start dipping. I think Tesla was a valid opportunity. I think Apple was a valid opportunity. Something that you don't really want to go too heavy in, but I think the setup and the context and everything that you wanted to see if you wanted to invest in this company was valid earlier in the month and in August. But now because the market is trending so much, S&P is making new highs pretty much every week. The Nasdaq is making new highs now, right? Yeah, the Nasdaq is definitely making new highs. You probably just want to wait. And we know that the market is going to dip eventually. The people that have the patience to wait for that dip are always the people that are going to have the best chance to produce generational wealth. And it's kind of ironic, right? Because you look on social media and you see people that are saying, oh, the harder that you work and the more time that you put into trading, the more trades that you have, if you're staring at NYSE all day, you're going to make some good money. You're going to make life-changing money. I really could not disagree more. I really truly believe that the more you wait, the more opportunity you're going to have to make that money that is life changing. It's not the more trades that you take, it's the quality of trades that you take. And the only way to understand if the quality is there in the trade that you're taking is based on the contextual perspective of the charts, right? The structures on the chart is going to dictate who's trapped and who's in control on which time frame. And you must understand you as a human being. Are you an aggressive person? Are you a hyper person? Are you somebody with a lot of passion and motivation for this game? That's going to dictate which time frame that you can be on. Even your personal life situation. Do you have a full-time job? Do you have kids to take care of? That's going to take away from the time frame that you can trade, right? So trading is very deep. It's very deep. It's not just charts. We've been reading this book, right? It does a fantastic job of talking about why the technical analysis is just 50% of the game, probably less. And the psychological aspect of this game, the situational aspect of this game, it takes precedent. And really and truly, there's enough money to go around for everybody in the world. So everybody should be profitable. But why isn't everybody profitable, right? It's very deep. Let's see here, page 193. We'll do a little bit of reading today. So you just need to have collateral. It depends on your broker. Shares that you own of the stock can be used as collateral, or you can use cash as collateral. But you will need to have a significant amount of cash for that collateral, because if you are to be assigned, it's fixed 100 shares. So if you're getting assigned 100 shares of Apple, Tesla, whatever, that's a lot of shares, right? So you need to have the cash to do so in your accounts, or you won't be able to sell premium, right? You can also do specific strategies with options like iron condors or straddles, but that takes a learning curve, right? Yeah, that's why professional traders, they'll always tell you that cash is king, right? You need cash in your broker all the time. And if you're negative cash, you're going to get charged interest because technically you're borrowing from your broker to own those shares. So you're going to get charged interest. It's really not that bad for interactive brokers. But I think for other brokers, the interest gets bad because they want to take advantage of of newbie traders, right? That are always negative cash. So cash is king. Make sure you have cash reserved. Let's say, for example, knock on wood, something very bad is to happen in the world for a geopolitical event, and let's say the S&P crashes 10%. You're gonna need some cash in your account to sustain drawdowns in your long-term investments, and you're gonna need cash in your account to reload in those investments as well, because you want to compound your investment. You don't want to just buy one level and hold it forever. No, you want to compound over time, right? That's just economics 101, right? But as a futures trader, if you have the raw ability to ignore all the noise and to simply focus on a specific edge, like false breakdowns in a bullish trend, then you can make a lot more return than you would on investments. Personally, that's what I truly believe, because futures is leverage, right? Futures, you can make a lot or you can lose a lot. It's all leveraged. That's what futures contracts means, such that you can make 5, 6, 10R in a few days with futures, and 5, 6, 10R, it might take you years to make that with an investment, right? So that's really why futures will always be extremely significant to professional traders. Right, so with futures, I could do a little lesson here. With futures, it's the exact opposite of options. Futures is like shares. When you're executing futures contracts, you buy and sell, and if you don't have a stop loss, your account can go to zero, right? You're not buying premium. Simply the cash that you have in your accounts is your collateral, such that if you don't get stopped out of your futures contracts and it keeps going down and down and down, if you're long and it keeps going down and down and down, eventually you're going to get margin called if you run out of cash, right? So you need some sort of collateral. It's like shares, right? It's like shares. Every quarter we have to roll to the next expiry, so we only have 4 contract rollovers per year, right? It's not you get to pick your expiry. We have zero DTE. We have weekly, monthly. No, there's only 4 expiries for the year. We have 4 contracts. We have 4 quarters, right? And each quarter you have to roll over if you have an existing position. I don't think the broker is going to roll over for you. It probably will just liquidate it, but it won't roll over. So what I mean by roll over is that you have to buy again. If you're long on the September contract and you want to be long in the December contract, you have to buy again, right? I'm pretty sure most brokers won't buy for you, right? And that's pretty much it. When it comes to execution, though, you don't have any Greeks. You don't have time decay to deal with, and you don't have the pressure of your position getting crushed overnight, right? Because you can manage your position overnight. The futures market is almost a 24/7 market. It closes for an hour during the week from 5 to 6 p.m. Eastern, and then it closes on the weekend and reopens Sunday 6 p.m. So this position tool right here is the most important tool on your TradingView chart if you're a futures trader, because this position tool is going to become your best friend in calculating fixed risk management. As a futures trader, you have the ability to lose X amounts and to make X amounts every single time, right? So there's no Greeks. There's no Greeks messing around with your trade. It's literally just the futures contract and you. So let's say, for example, here, this is the ES chart. I want a 20, let's just do the FOMC low. So let's say I want a long 66.11, and I want to have a $200 fixed risk, and I want a 20-point stop loss fixed. Everything is fixed, right? So there's your 20-point stop. So this position tool is telling me that I need 0.2 ES contracts, which is just the equivalent of 2 MES contracts. So this is even more reason for traders not to use prop firms and things like that, because we have access to MES. MES is a new instrument. MES did not exist when my mentors were my age and when they first started trading. They had to trade ES, which was kind of nuts. You need a lot of capital to trade ES. But MES is just 1/10 of the sizing of ES. So each point on MES is just $5 versus each point on ES being 50. So I need two MES contracts to sustain a fixed risk of $200 if I want my stop loss to be 20 points of distance from my entry. So 66.11 versus 65.91, that's my trade. And if I get stopped out, I'm losing 200 bucks. If I make 20 points, I'm making 200 bucks. If I make 40 points, I'm making 400, etc., etc., etc. And then obviously you can scale out your contracts. So you can scale out 50% at 3R, then you realize 50% of that 600, and then you can trail your stop loss, right? You can do a lot of stuff, but it's very simple. Treat it like shares. Make sure you have a stop loss. Make sure you have a target. It's serious business here with futures because you're not buying premium. When you buy premium, you only lose that premium if the contract is to go against you. But with futures, as soon as you buy it, you're invested. And if your stop loss doesn't get triggered, because you didn't have a stop loss in your broker, your account can go to zero. So that's very, very important to understand. For me personally, I've been trading futures since I was 19. I am now 23. And it's been 4 years of me not getting margin called. So the only way that you can get margin called if you do have a stop loss is if your stop loss gets gapped. I'll tell you just to make you feel comfortable that hasn't happened to me, knock on wood, in 4 years, right? That has not happened to me in 4 years. But obviously be smart and know your trade. Know the context behind your trade. If you need more information, I highly, highly, highly recommend to ask ChatGPT, ask AI, even screenshot some stuff and send it to ChatGPT. It's going to answer everything for you. Honestly, interactive brokers, they're absolutely phenomenal. They're fantastic. Their service is next level because they are $1 billion brokerage. But if you want fast and quick information, I really do feel like AI is the way to go. If it's like stocks, so what's the difference comparing to buying stocks like SPY, since SPY is related to ES? Because ES is now the high leveraged index of SPY, right? You're trading the futures contracts. You're not buying shares of SPY. You're buying the high risk, high leverage futures contracts, right? So if you wanted to own SPY, it's recommended to just pick up SPY, right? But now when you trade futures, you're playing the point-based system. And you can definitely hold futures as well. But futures, because it's so high leverage, you're going to require a lot of margin in your accounts as well. You need to hit those margin requirements, or else you simply just won't be able to hold the futures contracts overnight, right? There's specific brokers that don't require margin. I think NinjaTrader is one of them, but that is a little fishy in my perspective, because why would you tell traders, okay, you can have 500 bucks and trade such a high risk leveraged instrument, right? That 500 bucks is probably just going to disappear, right? Versus interactive brokers, you need margin. Each contract for MES is $1,800 of cash that you need in your account to hold overnight. So that to me just makes me feel safe, right? And that adds edge to your trading. Yep. So let's go to page 193. Best loser wins. I was talking about with my mentor earlier today that I'm very happy that I started reading these books with a good amount of experience under my belts. I think whenever we read trading books, it's important for us to relate what the book is talking about to our own personal situations and own personal experiences inside and outside the markets. So from a financial perspective, from a risk reward perspective, from an execution perspective, and also from a psychological perspective. And there's a lot of fantastic stories that you will read that will benefit you in these books. But make sure, get your feet wet first, right? Get your feet wet first. I don't like when traders start with books. Traders should start with the chart. The chart is the best book you'll ever read in your life if you're a professional trader, right? So start with the chart and then look to external things for help. Would you recommend using the option spreads if we don't have a margin account to replicate your MES trades? Yes, for sure. 110%. 110% you can do that. I know there's a decent amount of members that do that. So the levels are relative, right? So all-time high is the same on MES as it is on SPY chart. So you definitely can do that. 110%. And the percentages are relative as well too. So all-time high to the FOMC low, -2%. It's going to be -2% on the S&P 500 as well. And you can use that information to your advantage, right? -2% is a place where you want to be assigned. So if you're selling premium, you probably just want to get wherever this strike is. So let's just quickly look at the SPY chart. SPY. So the last Wednesday's low, let's go to the 4-hour. Last Wednesday's low is right here. Where's Wednesday? Right here. Let's measure it, high to low. Yep, literally -2%. So if you're buying, or if you're selling premium, excuse me, then the 650 strike makes sense. Very out the money. You can do this 1 month out, 2 months out, 3 months out, right? Very out the money. You're looking for a -2% dip on the S&P if you want to be assigned. And if the S&P doesn't dip 2%, by the time it expires, you're going to collect all that juicy premium. So that's pretty much what Rich has been doing as of late since May with this crazy uptrend. And eventually, when we do get assigned, we'll be happy because we're going to buy there anyways, right? We're going to buy there anyways. All right, let's keep open the daytime frame, the 4-hour chart here. Yeah, so basically what you would do is you would go into the options chain. Can you show that, for example, what spread to buy or sell? So for me personally, I am not the best with options, but I've been looking into it. And if you're selling premium, or if you're looking to get in with the spread, or if you're looking to an iron condor or something like that, for me, I think what makes the most sense is to go as far out the money as possible. And what I mean by as possible is look at the macro time frame structures. So you're not guessing, right? You're not guessing a -2%, -5%, whatever. You know that the FOMC low on the futures chart and the S&P 500 SPY chart, you know that that's a significant low on the chart, regardless if it's -2% or not. So wherever that strike is, you're going to hunt it. And you can apply the iron condor, you can apply spreads, you can do whatever you want, really. But I think at the end of the day, especially for the S&P 500, your primary focus should be these dips, right? That's why we love selling premium, because that's the focus. It's the dip, right? If you are to be assigned, we want to buy the dip. So why wouldn't you sell premium before the dip happens, right? And when we're in such a crazy uptrend and you're collecting those premiums, it's pretty much free cash, right? I've been looking into 0 DTE premium selling as well. I don't think it works that well with MES because MES just doesn't have enough volume in the futures options compared to ES. But that's something to look out for as well. If you have a decently sized account, you want to sell premium on ES and you want to do 0 DTE. So the reason why I'm talking about 0 DTE is because if you're somebody that's reading the chart from an external contextual perspective, let's say you know that FOMC is on Wednesday and you know that we're likely to have a 20-point range on Monday, then you can sell those 0 DTE premiums 1 to 2% out the money, right? And you collect all those premiums by the end of the day. You can make an easy, $100, $200. And that could be life-changing for some people because that could pay your bills, right? That can buy your groceries. And that's what financial freedom means in trading. Other than that, if you have more questions about options, I highly recommend to reach out to Rich because Rich has been spending a lot of his time with options this year. For me, it was all about refining the futures process. I feel like I definitely mastered futures at this point, and I definitely refined my process to the point where it aligns with everything that I want to do in the markets. Now I'm spending more time with options, and we'll see how it goes, right? We'll see how it goes. Eventually, I will get that $1 million account as well. So congratulations to Rich for that $1 million account. That's absolutely nuts. Absolutely nuts, right? We started from humble beginnings. We used to be delivery. We used to do delivery services with our parents, right? We used to make minimum wage, whatever. So to see that is extremely inspirational, extremely. So page 193, best loser wins. If you have the physical copy, the online copy, now's your time to bring out the book. page 193. We only have about 40 pages to go. So please, please, please send me your recommendations for the next book that we're reading. We'll read anything that you guys want to read. It doesn't have to be trading, right? It doesn't have to be trading. It could be about life. It could be about psychology. Anything you want to read, I'll be interested. Embracing Failure. The late Mark Douglas, which is an absolutely phenomenal trader as well if you guys want to read his book, argued that successful trading is a question of accepting risk and thinking differently. The market wizard trader Ed Seykota put it in another way. A losing trader can do little to transform himself into a winning trader. A losing trader is not going to want to transform himself. That's the kind of thing winning traders do. When I read that passage the first time, I was not mature enough to understand its importance. When I started trading for myself, I began to appreciate its depth and wisdom. So that's literally the reason why I tell people, get your feet wet first and then read these books, right? So Tom is literally telling you as well. As I began trading bigger and bigger size, I realized that my journey from a low stakes trader to a high stakes trader was not the result of evolution. Sure, I got better the more I traded, but remember this, practice does not make perfect. It merely makes its permanence. Only through a dedicated approach to practice with a specific attention to finding your mistakes will you improve. Otherwise, you are just cementing your unprofitable behavior. Becoming a different person. Being anxious and fearful is a reflection of an unknown situation. Through exposure over and over, our minds come to accept the new reality, and through that exposure, become accustomed to it. You think there is a hack that will all of a sudden take you from trading $10 a point to $100 a point. You think there is some book you can read, or some course you can take, or a pill you can ingest that will take you from being an average stake trader to a high stake trader. Well, not quite. But there are certainly ways you can accelerate your progress. It is a question of priority. I'm not some hardcore monk with no life and a never-ending commitment to pushing myself into those cold, dark corners where I dance with uncertainty until my emotions are stunted and I essentially become a psychopath with no fear. But I am committed. I want to explore my weaknesses. I am reasonably attuned to my mind and body, and I know that left to my own devices, I can quickly spiral into self-destructive behavior. I had a painful breakup with a loved one, and I turned to food and alcohol. Sure, I think we all do things like that. Even Bridget Jones, I love movies, ate her way through a tub of ice cream in one sitting when she was dumped by the love of her life. But you move on. You get off the sofa, you turn off the TV, and throw the ice cream bucket in the bin, and you say, okay, so I made a mistake, I will own it. How you feel about failure will, to a very large degree, define your growth and the trajectory of virtually every aspect of your life. You may want to close the book and think about that for a while. It is quite frightening how deep that sentence is. A significant part of your success as a trader is correlated to your relationship with failing. If you see failure as the end game, then you won't make it as a trader. I have colleagues who will stop trading if they have 3 losing trades in a row. What kind of attitude is that? You think Kobe Bryant, the absolute Superman of basketball, had that attitude? You think during a game he would make 3 misses and then ask the coach to be replaced by someone else? So for me personally, when I first started trading, if you guys remember all the way back then, let's see if we have any veterans in here in the Trading Wars Discord. Yeah, I see at least 1 or 2 people. So in 2022, 2023, I would go on 10 trade losing streaks. One day I should find that spreadsheet. The spreadsheet is somewhere. I should find it. But I would lose minus 10 hours straight, right? I would lose for 2 weeks straight. And that wasn't because I was a bad trader. That was because the system I was implementing had a 25% win rate, but that was because the risk reward was so good. I was getting 3 or 4 R every single winner, right? So every single winner I had in my spreadsheet, it was 3 or 4 R return, 3 or 400% return on every single winner I had. So if you want to think of it like that with options. But every single loser I had was minus 100%, minus 1 R, minus 1 R, minus 1 R. But eventually I would hit it. Sometimes I would win 3 trades in a row, and those 3 trades in a row would pay for the entire month, right? However, it reached a point to where it was literally unsustainable to my capital being that age at the time, and it was unsustainable to my mental health as well. Like, think of it like this: if you're losing 80% of the time in the stock market, eventually those demons and those negative emotions, they're going to get the best of you eventually. So you have two opportunities, or you have two decisions, you have two choices. You can quit and be and say to yourself, you tried, it didn't work out, it is what it is, move on. Or you can continue to refine what you're doing, because obviously you're doing something right if you're profitable with a 25% win rate, but you can refine it to increase that win rate, even if you have to sacrifice a little bit of risk to reward. And refinements really comes down to honesty. So you have to be honest with yourself. Regardless if you're profitable or not, is this sustainable? Is this something that you can do for the rest of your life? You have to be honest. Number two, how can I actually improve? Be honest with yourself. Am I doing the right things to improve? Am I journaling to understand the statistics in my data? Am I journaling my real-time trades to see patterns in the chart that I can take advantage of? Or am I literally just turning my everything off and doing whatever I want, right? So eventually I reached a point where I noticed false breakdowns could be an edge to increase my win rates. I noticed that I love prior day ranges. I love the higher lows in the prior day range. But the false breakdown was really the reason for why those prior day ranges created traps to move higher. And eventually I reached a point to what I'm doing right now is I know that I want to take advantage of those prior day ranges. I know that I want to take advantage of those monthly ranges. I know I don't want to be on the 5 minute chart anymore. I don't want a 25% win rate anymore, right? So when I zoom out now and I'm taking advantage of these extremely large ranges, I can still get those 3, 4, 5, 6R winners like I was getting before. But now the win rate has increased because the frequency of the trades has decreased. Now the quality of these setups are really good, but they're the exact same structures that I was taking on the 5 minute time frame. Because the frequency has decreased, the losers has decreased, the quality has increased, and I'm a lot more confident, right? Yeah, so what I like to do is I like to differentiate the specific ranges, right? So exactly, confluence. If you're an intraday trader, you're pretty much only looking at the past few days. It depends on the structures, right? So the prior 2 day range, Thursday and Friday, is more significant than last Monday's range. But we're essentially using confluence with fibs and false breakdowns to create the Fibonacci trap, right? Prior day's lows are always going to be significant areas of interest, even if they're not high quality lows. So what I mean by high quality lows is those -1%, -2% dips. They're always going to be significant lows because there's always going to be a lot of people with their stop losses at a regular trading hours low. And we know that the market needs liquidity. It needs it literally to exist. So it's going to hunt those people with their stop losses at the lows. So for example, today, the 9:30 a.m. low, 6,700. If this gets a false breakdown tomorrow, I would be absolutely not surprised at all, right? There's going to be a lot of people with their stop losses here. A lot of stop losses are here. And you can literally just look at the price action. You can look at the candlesticks to give you reason as to why there's a lot of stop losses, right? That's why these hammer candlesticks mean a lot. So you have the Thursday low, beautiful hammer. You have last Friday's low, beautiful hammer. There's probably a lot of stop losses there to collect liquidity in order for us to move back to the upside, right? There needs to be reason for everything on the chart. And especially the more that you zoom out, the more reason price action needs to do specific things. If we're going to crash the market, it needs a big reason. If we're going to correct the market, it needs a big reason. If we're even going to pull back the market, it needs a big reason. If we're going to trend above all-time high, it needs a reason to do so. So these reasons equals the internal and contextual analysis that we do. And then you simply just execute the entry models at those high quality areas or the intraday areas. It's really just up to you how you want to trade. So to put it into a nutshell, we want to take advantage of who's trapped and who's in control. The more time you spend watching specific tickers and specific indices and instruments like the ES chart, the more you realize that this chart is just a big algorithmic machine. It does the same thing over and over again. There's just so much money involved with these instruments that it has to do the same thing over and over again. Nobody is gambling billions and trillions of dollars. There's a methodology, there's a system and a process behind this money, right? It has to fluctuate consistently, or else the world is probably just going into a crazy spiral like in April, right? So for me, I'm looking at these very, very, very significant dips, and I'm always zooming out to the higher time frame. Number one question I ask myself, is the higher time frame bullish, bearish, or neutral? The higher time frame has been bullish since April 21st. It has not changed. Maybe it's gotten a little bit neutral like in May, but it has not been bearish since the market crashed in April, the beginning of April. So with that in mind, I'm looking to buy the dip. But how do you actually buy the dip? You have to look for specific entry models. You have to look for specific trade location. You have to look for a specific edge. If your entry doesn't have an edge, you're probably just going to get stopped out and you're going to get left frustrated. That's why the false breakdown is a key and prime entry model. If you look at social media and you see liquidity sweeps, you see turtle soups, you see this, you see that, it's just a false breakdown, right? They remodeled it to sell it to you, but it's just a false breakdown. And the false breakdown has existed since day one of the S&P 500 200 years ago, right? So when I see a high quality false breakdown now at a high quality low of interest, I'm confident to buy there because I know that I know that the higher time frame is bullish, and it doesn't matter if I win or lose because my trade plan is telling me that all the stars are aligning. If I'm going to lose, then the market is probably has a crazy reason to do so, and that it's all good. It is what it is, and I'm literally just rinsing and repeating. The 9th September low, that's the best, or ideal dip 618. So 9th of September is right here. Yeah, so that's a decent example. So what you'd always want to do is you'd want to draw the structures, right? So the structure you have here on the 9th of September is the 8th of September low. And if you really zoom in here on the 4-hour chart, obviously if you go to a 15-minute, you probably see easier. But you notice that this wick printed a false breakdown of the September 8th RTH low. So this is the September 8th RTH low. This is the September 9th RTH low. You can see it right here. We sliced below it and we immediately recovered back up. That's an A plus high quality false breakdown, and we retraced about 50% of the range. If you're using the Friday, September 5th low as your significant pivot, right? So Fibonacci is very simple. Fibonacci is just trend continuation. That's what higher lows and lower highs means. That's why the 50% and the 0.382 we talk about all the time, it's showcasing continued strength, continued momentum. So whenever you're drawing anchor one, you want to draw it with where the trend really started to take off. And different time frames are going to show you different starts of that trend. If you're on the 4-hour macro time frame, you're probably looking all the way back to September 2nd. You go into an intraday time frame, you zoom in a little bit more, you're using that September 5th low. You zoom in even more, you're going to use the FOMC low, September 17th. You zoom in even more, then you can use today's low. You zoom in even more, right? You get the idea, right? So your time frame is very, very important. At the end of the day, trading is a niche, and you have to find your niche. Macro time frame is my niche. Maybe the 5-minute time frame is your niche. At the end of the day, trading is fractal. These structures, they look the same. They all mean the same thing on every time frame. It just depends your frequency, your personality, and definitely your situation. Yeah, 4 hours is my favorite. 4 hours is my favorite. 4 hours actually been my favorite since 2023. That's really where I started to zoom out. Or was it 2022? I don't remember. But that's when I really started to zoom out. And as soon as I zoomed out, I got out of the 5-minute time frame. I got out of the 15-minute intraday time frame. As soon as I started to zoom out, everything started to click, right? Everything started to click. The macro time frame shows you the true narrative of what's happening. There's a lot of noise on the smaller time frame. A lot of noise, right? So when you zoom out, everything comes a lot more clear. The trend is your friend. There's nothing more significant in the stock market. There's nothing more significant in economics than the trend. And the only way you're going to see that trend is if you zoom out and you continue to zoom out, right? Zoom all the way out. So I have levels going all the way back to August 1st, right? And then the more time you spend with ES or any ticker really, you can understand its personality. You can understand the market participants that are involving themselves in the ticker. You can understand, based on how price action is moving, the emotions of those market participants, right? And I know that if specific levels are to fail, that can make emotional traders. And if emotional traders are active, I'm going to be active as well, because that's the best time to make some good cash. When traders are emotional, then price action is emotional, or that's what it's showcasing to you, and that's when you're going to get these wicks, right? That's when you get these wicks on FOMC day. That's when you're going to get these wicks on September 2nd. Emotional traders. The higher time frame is bullish, buy the dip, and we reverse. However, that being said, if the higher time frame trend is to change, like in April, and we're crashing, doesn't matter how many dips you buy in that situation and you run out of cash, you're going to blow up. If we're dropping 1,000 points and you're buying a dip every 200 points, you're probably just going to run out of cash before the market starts to recover. So that's why I have these notes on my chart. Correction below. Okay, if we break down 64.20, right? If we break down 64.20 minus 5%, and then we're going, we're probably just entering a phase of correction. And we have to be careful. We have to adapt. Sure, I can definitely show an example. So here is my evening homework. This is 9/18 for 9/19. So this is last Friday. Every single evening, I will write down my levels of interest. So this is last week, 65.77. Obviously, I adapted it on Saturday. And I'll always do a little bit of writing here to make sure my mindset is right? I don't want my opinion to be involved in the chart. I just want the market structures and my edge and my process to be involved on the chart. I don't want anything else. That's why I always write these notes. So this is Friday. Heading into tomorrow, let's see if the market can contest the first high quality low of interest, being yesterday's FOMC low. It's such a massive low and significant level that will change the internal context for the intraday charts. I will remain focused and patient for the next macro dip. So this sentence right here, I will remain focused and patient for the next macro dip. This makes all the difference in your trading, in my opinion. It will make all the difference in if you actually can become profitable or not. If you're telling yourself you will remain focused, you're more likely to remain focused than if you didn't have this, right? If you didn't have this. And in my trade plans every single day in the pre-market, I'm literally just copying and pasting. I'm making sure my mental is ready to execute when my trade plan is active. Because the worst case scenario is you get, let's say, for example, 6611 gets contested. Your entry model is a false breakdown. You have all the criteria ready to click buy, but you couldn't click buy because your mindset is just not in the right place. And I think that happens all the time for traders. So we are on page 195. I have to head out here, so unfortunately I cannot continue reading. But you can see here how the process is so important. Process is everything. Alrighty, fantastic session. A lot of lessons and notes to be taken. Again, if you revenge traded today, because I know for me personally, I've definitely done revenge trading at all-time high before. Oh yeah, 110%. If you're somebody that did that today, no worries, no doubts. Just journal it and make sure next time you learn as to why you revenge traded and make sure you don't repeat the same mistakes. Because when the market runs, if you don't have rules, you can't make a firm decision. Exactly. If you don't have a plan, exactly. You cannot make firm decisions. And especially on days like FOMC, when price action is moving like a bullet train, if you can't make a decision quick and in real time, you're probably just going to miss the trade. And if you miss the trade, what does that lead to? It leads to revenge trading as well. So revenge trading goes both ways. If you miss a trade or if you lose out on a trade, you can start buying highs because you missed. your original entry, etc., etc. Sometimes there's nothing wrong with that. Sometimes you do have to buy in a little bit higher. Sometimes it's just literally too quick. But at the end of the day, you have an entry model, you have a level, you have an edge, and you just execute. You turn your brain off, you turn your emotions off, and you execute. I also talked about the significance of MES today. MES really and truly does not require that much capital for a $100 to $200 risk. And I truly believe that if you want to be a pro in this game, you have to risk real stone cold cash. That's the only way you're going to get these emotions of trading that you need to manage to come out. If it's a prop firm or if it's paper, you're never, in my opinion, going to get these emotions out of you, right? Because you're never going to care that much. But if it's your own hard-earned capital, you're going to get all of these emotions on a blank page for you to tackle, and you have to write down how to take care of it, because professional traders, the only reason why they're good at what we do is because they are the best at managing those emotions. So I'll see you guys tomorrow. Stay tuned for the evening homework report, and we'll see when the next macro dip happens. Whenever it happens, I'll be ready. That's about it.